According to the National Association of Realtors, the price for an existing home, one that is already standing and not new construction, was over $387,000 as of November 2023. Now, unless you're one of the small percentage of folks who have that sort of cash laying around, you're going to need a mortgage when it comes to buying a house. If you don't want to be intimidated by this process, stick around and let me fill you in on what to expect. Hey guys, it's Dana here with Real Estate with Love, where we make real life, real estate, real simple. So subscribe, share, hit that like button, and most importantly, turn on those notifications so you can be informed each time we upload new content. Getting pre-approved for a mortgage is really not that difficult, especially when you know how lenders think. Having spent 11 years as a lender, I can tell you that they're looking for these 4 things: your income, your debt, your credit, and the property appraisal. 3 of these things are totally within your control. So let's talk about the first one, your income. Most lenders are going to take a look at your previous 2 years' tax returns and at least 1 month of your recent pay stubs. And here's what they're looking for. They want to make sure that your income is stable, meaning you've managed to remain in your current job for a decent period of time, 6 months to a year or longer. They likely won't hold it against you if you've recently changed jobs, so long as it's within the same industry. For example, if you're a school teacher and you're just working for a different school, or if you're a nurse and you move to a different hospital. The second thing they're looking for is they want to calculate how much of your income can be used for housing. Usually, the acceptable number is anywhere between 43 and 45% of your gross monthly income. That is your income before taxes. But this may vary depending on the lender. This is called your monthly allowable housing expense. So let's take a closer look at an example of this, of how it's calculated. Let's say you make $50,000 a year. That comes out to about $4,167 a month. Multiply that times 43% and you get $1,792 a month. That is available for housing. Now, let's look at the next part, debt. Let's define exactly what debt is from the lender's perspective. Debt means simply that you filled out an application and borrowed money. Examples of debt are your car payment, your credit cards, any personal loans, and yes, those pesky student loans. Things that are not considered debt would be things like your electric bill, your phone, internet, or cable bill, or childcare. Lenders are going to subtract the minimum monthly payments owed to your debtors from the 43% of the gross they've allowed for housing, even if you normally pay more than the minimum. Example, your monthly allowable housing expense is $1,792 a month. Your car payment is $400 a month. You have 2 credit cards that have a total minimum payment of $100 a month. You have a student loan payment of $100 a month. So that means your total monthly debt is $600 a month. Now subtract that from the $1,792, and now your allowable monthly housing expense has been reduced to $1,192. When I used to do mortgages, I would do this next calculation manually. However, I'm sure lenders today have a fancier way of doing things, so I'm not even going to try to show you this calculation. But what they're going to do is take your monthly allowable housing expense and use that number to come up with a maximum budget that you can spend on a house based on a specific interest rate. In this particular scenario, using an interest rate of 6%, your maximum that you can spend on a house would be a little over $198,000. Now, this brings us nicely to the next part in this equation, credit. Now, I know for a lot of you, this is a big one, but don't be intimidated by this. Even if you've had bad credit, the key to overcoming this obstacle is simple. You have to put it in the past. Put as much time between you and bad credit as possible and work diligently towards paying everything on time to get yourself reestablished with good credit. Now, you can get a mortgage with a credit score as little as the low 600s, or in some instances the high 500s, although that's going to be a little tougher. However, for the purposes of purchasing a home, the ideal credit score will be somewhere in the mid 600s and above. The last part that the lender is going to review is the property appraisal. Now, this part is completely outside of your control, but suffice it to say that in most cases, the home you're purchasing has to appraise for at least the purchase price. So hopefully I've provided a little bit of clarity for you in regards to getting a mortgage to purchase a house. Now you can go house hunting with your local realtor. Hey, thanks for watching. To learn more about real life, real estate in a way that keeps it simple, subscribe to my channel, hit that notification button so you know exactly when new content is being uploaded. See you next time. Bye-bye.